So I think it's the biggest issue people are focused on the moment at the moment. So I think going into earnings, people were very focused on the upside from higher interest rates. So clearly these banks are major beneficiaries of rate hikes. In addition, we've seen that loan growth has also started to pick up. So you've got this combination of both margin expansion and volume growth, which is obviously really, really good for the top line. But I don't think people had really thought through the ramifications of just the broad cost inflation that we're seeing across not just banks, but just broader industries. So clearly, I think, look, going into earnings, the market was pricing a lot of the positives. They weren't pricing in some of the offsets. Cost inflation was clearly one of those. And JP Morgan really highlighted that. So look, what JP Morgan set out is that their expense base is going to increase from roughly $71 billion last year to about $77 billion this year, so a $6 billion increase. And a lot of that is centered around technology and investment in their franchise. And it's clear, look, two things are happening. The first is obviously it's a very competitive employment market. And secondly, these banks are seeing a lot of competition from fintech companies and from payment companies, and they're having to respond to that.
In terms of that kind of competition we're seeing for staff, clearly hiking bonuses, and in fact your CEO, David Solomon, was clear on his call that they could then cut them if necessary in a year ahead. Hiking bonuses is one thing, but we've now seen lots of stories of the likes of Merrill Lynch, Bank of America, having to pay higher base salaries. And you start to see a bit of a competition for talent that is to the extent that we haven't really seen since, say, 2005, 6, 7. I mean, is that a fair comparison that puts a little bit of concern in your mind or not?
I think, look, that is happening. There's no question. So again, if you look at JP Morgan, we estimate about $1 billion of the increase is because of merit increases in compensation, which is salaries, for employees who don't necessarily work in the investment bank. So clearly, even outside of capital markets, where you've obviously had this war for talent now for the best part of a year, you are seeing a lot of competition, for people in branches, for people who work in technology, for people who work in accounting operations as well. So, look, it's a lot more broad-based. It's something I think that people are focused on. And I think, look, the question I think people are asking is, longer term, to what extent can technology offset some of the wage inflation that we're seeing, given this very rapid shift towards digital, in terms of just preferences of the way in which consumers interact with banks.
What's your take on that, Richard? Do you think that technology does have the ability to supplant? I mean, these are big numbers you're talking about with regard to wage increases or salary and bonus increases here, and their expense trickle down to the companies. I mean, is it something that you do believe technology can supplant that over time?
100%. I think this has been happening in the banking industry for a long period of time, where you clearly do have this substitution of technology for labor, and it's something which I think is not just going to continue; it's going to accelerate. And I think it's accelerating because consumer preferences are changing. I mean, the way in which consumers want to interact with their bank has just changed fundamentally over the last 3 or 4 years, partly because of the pandemic. And I just don't think that's going to go back as the world normalizes. So if you look at, I think one of the biggest opportunities for cost savings, it's things like usage of cash and checks. So again, if you look at JP Morgan or Bank of America, you look at their expense base, about 10% of it is just processing cash and checks. And obviously we're starting to see usage of cash and checks decline quite rapidly, and that you have the shift towards P2P type payment platforms. And I do think that is going to give a significant opportunity for these banks, to really eliminate expenses as you shift towards this digital world. Secondly, you still have a very large number of branches in the US. I think over time, you will continue to see branches decline, again, because they're just not needed, because there's just other ways of interacting with the banking system that's a lot more efficient for everybody.